Think about this for a second. Today, you can open your phone, tap a few buttons, and instantly own a tiny slice of the 500 largest companies in America. You can do it for essentially zero commission while sitting on your couch in your pajamas. It costs almost nothing. It takes almost no skill. And over the long run, it tends to outperform the vast majority of professional money managers who charge enormous fees to do what your phone just did for free. That simple, almost boring act of buying an index fund is arguably the most powerful wealth-building tool ever handed to ordinary people. But here's the part that nobody really talks about. That tool did not exist until 1976, which means that for the overwhelming majority of American financial history, from the founding of the Republic all the way through the bicentennial, regular people had no access to the thing that we now consider the default way to invest. No S&P 500 fund, no total market fund, no target date retirement fund built on indexing, none of it. So what did they do? How did your grandparents, your great-grandparents, and every generation before them try to grow their money, protect their savings, and prepare for old age in a world where the index fund had not yet been invented? The answer is far more fascinating, far more dangerous, and far more revealing about how power works in America than most people realize. Because for most of this country's history, the financial system was not designed for you. It was designed to extract from you. And the story of how that changed is one of the most important and most overlooked stories in modern economic history. Let us go back to the beginning. In the early days of the American Republic, the very concept of investing as we understand it today would have seemed alien to most people. The New York Stock Exchange was founded in 1792 when 24 stockbrokers signed the Buttonwood Agreement beneath a tree on Wall Street. But for the average citizen, this was a world as distant and exclusive as a royal court. Stock trading in the 18th and 19th centuries was the province of the wealthy, the well-connected, and the reckless. If you were a farmer in Virginia or a shopkeeper in Massachusetts, your wealth was your land, your tools, your livestock, and whatever coins you had buried in a jar. There was no such thing as a risk-free investment. The United States government did not issue treasury bills as we know them. Bank deposits were not federally insured. If your bank collapsed, and many of them did, your savings vanished with it. The entire financial landscape was a minefield of uncertainty, and ordinary people navigated it with almost no protection whatsoever. By the middle of the 1800s, corporate stocks and bonds were beginning to appear more frequently in the portfolios of wealthier Americans. Research into the estate records of this period shows that by around 1850, roughly 15% of total investor wealth at death was tied up in corporate securities, up from less than 4% just a few decades earlier. But these were not ordinary people. These were landowners, merchants, and industrialists. The typical American still relied on the most ancient forms of wealth preservation, land, physical goods, and the goodwill of their community. When Charles Dow started publishing a daily index of prominent stocks in the Commercial and Financial Chronicle around 1885, the precursor to what we now call the Dow Jones Industrial Average, stock ownership was still overwhelmingly concentrated among the elite. The mechanics of buying a share of stock were cumbersome and intimidating. Ownership was evidenced by paper certificates that were difficult to transfer and easy to lose, steal, or destroy. There were no regulations to speak of. Insiders manipulated prices freely. Panics and crashes erupted with terrifying regularity, wiping out fortunes overnight. For most Americans, the stock market was not an opportunity. It was a casino run by people who had no interest in your well-being. But something started to shift around the turn of the 20th century. The American economy was growing at a staggering pace. It had become the largest economy on earth by the 1880s, and by the early 1900s, a new class of major investment banking firms had emerged. Names like J.P. Morgan, Goldman Sachs, and Lehman Brothers were rising to prominence. And as the economy expanded, so did the appetite for speculation. Historians estimate that the number of individual stockholders in the United States grew from roughly 4.4 million in 1900 to somewhere around 18 million by 1928. That is an extraordinary expansion, and it was driven by a few powerful forces. The first was the sheer momentum of economic growth. The early 20th century was a period of incredible industrial expansion. Railroads, steel, oil, electricity, automobiles. New industries were minting fortunes, and ordinary people could see it happening all around them. The second force was something less obvious, but arguably more important. It was a war. When the United States entered World War I in 1917, the federal government faced an enormous problem. Wars are fantastically expensive, and America needed money fast. Treasury Secretary William McAdoo devised a plan that would fundamentally reshape the relationship between ordinary Americans and the financial system. He would sell government bonds directly to the public in small enough denominations that almost anyone could afford them. He called them Liberty Bonds. The Liberty Bond drives were one of the largest and most successful campaigns to introduce ordinary households to the concept of financial investment in American history. Bonds were sold in denominations as low as $50, and they could be purchased through installment plans, meaning you could pay a little bit each week until you owned the full bond. The government launched a massive marketing blitz, complete with celebrity endorsements, dramatic posters, parades, and rallies. Movie stars like Charlie Chaplin and Douglas Fairbanks urged Americans to buy bonds. The message was simple and emotionally powerful. Invest, or the enemy wins. And it worked. Across the 4 major Liberty bond drives, over 22 million Americans subscribed, encompassing roughly a third of the entire adult population. For tens of millions of people, this was their first experience owning a financial instrument. It was not a stock. It was not a mutual fund. But it planted a seed. It taught an entire generation that you could take your money and put it somewhere other than a mattress or a cookie jar, and that doing so could serve both your country and your future. But there was a bitter lesson hiding inside this patriotic act. Many of these small investors who bought Liberty bonds at face value were forced by personal financial hardship to sell them before maturity. And because these were marketable securities, subject to the fluctuations of the bond market, many of them sold at a loss. The very people the government had urged to invest for the first time were burned by market forces they did not understand. It was a cruel introduction to the world of finance, and it left scars that lingered for years. Still, the experience changed something fundamental. It created a class of people who now understood, however imperfectly, that financial markets existed and that they could participate in them. And when the Roaring Twenties arrived, that seed of awareness blossomed into something far more dramatic and far more dangerous. The 1920s were an era of extraordinary optimism in America. The economy was booming. New technologies like automobiles, radios, and telephones were spreading rapidly. Consumer culture was exploding. And in this atmosphere of boundless confidence, millions of Americans turned their attention to the stock market for the first time. A new ecosystem of brokerage houses, investment trusts, and margin accounts emerged to serve them. The concept was intoxicating. You could buy stocks with borrowed money, putting down as little as 10% of the purchase price and borrowing the rest. The stocks themselves served as collateral for the loan. If the price went up, you could sell at a profit and repay the loan with money to spare. It seemed like free money, and for a while it was. Investment trusts, a precursor to the modern mutual fund, proliferated at a breathtaking pace. In 1924, there were just 49 such trusts in the United States. By March of 1927, that number had jumped to 179. And in 1928 and 1929, the market absolutely exploded. More than $1 billion flowed into investment trusts in the first 8 months of 1929 alone. These trusts promised ordinary investors the benefits of diversification and professional management. But many of them were leveraged to the hilt, structured in ways that amplified gains on the way up and devastating losses on the way down. Also in 1924, something quieter, but ultimately far more consequential happened. In Boston, a man named Edward Loeffler created the Massachusetts Investors Trust, which is widely recognized as the first open-end mutual fund in the United States. Unlike the closed-end investment trusts that dominated the market, this fund allowed investors to redeem their shares at the current net asset value at the end of every business day. It was a subtle but revolutionary distinction. It meant your money was not locked up. It meant the fund had to be transparent about what it was worth. And it was designed, at least in principle, to give investors of modest means access to a professionally managed, diversified portfolio of stocks. But the timing was brutally unfortunate. The Massachusetts Investors Trust launched into a market that was careening toward the most catastrophic crash in history. On October 29, 1929, a day forever remembered as Black Tuesday, the stock market collapsed. The Dow Jones Industrial Average lost roughly 89% of its value between its 1929 peak and its trough in 1932. Highly leveraged investment trusts were obliterated. Millions of Americans who had borrowed money to buy stocks were wiped out. Banks that had lent money for margin purchases failed, and those bank failures destroyed the savings of millions more who had never bought a single share of stock. The Great Depression that followed was not just an economic catastrophe, it was a psychological one. An entire generation of Americans learned the hardest possible lesson about financial markets. Stocks are not safe, banks can fail, your money can simply vanish, and for decades, this trauma shaped how ordinary Americans thought about investing. Many of them wanted nothing to do with the stock market ever again. In the aftermath of the crash, the federal government moved to create a new framework for financial regulation. The Securities Act of 1933 and the Securities Exchange Act of 1934 established the Securities and Exchange Commission and imposed new rules on the issuance and trading of stocks and bonds. The Investment Company Act of 1940 created the regulatory framework for mutual funds that persists to this day. And in 1933, The Glass-Steagall Act separated commercial banking from investment banking, a firewall designed to prevent the kind of reckless speculation that had contributed to the crash. One of the most important innovations to emerge from this period was the United States Savings Bond, introduced in 1935 by Treasury Secretary Henry Morgenthau Jr. The savings bond was specifically designed for the small investor. Unlike Liberty bonds, savings bonds were non-marketable, meaning they could not be traded on the open market. If you needed your money, you could redeem the bond directly with the government at a guaranteed value. You would not be at the mercy of fluctuating market prices. This was a direct response to the painful experience of Liberty bond holders who had been forced to sell at a loss. And when World War II arrived, the savings bond became the centerpiece of another massive campaign to get ordinary Americans to invest. War bonds, as they were commonly called, were marketed with the same patriotic fervor as Liberty bonds had been. The government sold roughly $185 billion worth of bonds across 8 separate war loan drives. More than 85 million Americans purchased them. By the end of the war, these bonds represented a huge portion of household savings across the country. But here is the critical thing. Even with savings bonds, even with the new mutual fund regulations, the financial options available to ordinary Americans in the 1940s and 1950s were remarkably limited. If you were a typical middle-class American in the post-war era, your wealth-building toolkit looked something like this. First, you had your savings account. Banks were now insured by the Federal Deposit Insurance Corporation, created in 1933, so your deposits were safe up to a certain limit. But the interest rates on savings accounts were modest, often barely keeping pace with inflation. Second, you might own your home. The post-war era saw an enormous expansion of home ownership in America, fueled by the GI Bill, the expansion of the Federal Housing Administration, and the construction of massive suburban developments like Levittown. For millions of families, their house was their single largest investment, and for many, it was essentially their only investment. Third, if you worked for a large company, you might have a pension. The defined benefit pension was the dominant form of retirement savings in mid-century America. Your employer promised to pay you a fixed monthly income in retirement based on your salary and years of service. You did not have to make investment decisions. You did not have to worry about market fluctuations. The company handled all of that. It was, in many ways, the golden age of retirement security for working Americans. But of course, it only worked if your company stayed solvent and honored its promises. Fourth, you might own some whole life insurance. For much of the 20th century, whole life insurance policies served a dual purpose. They provided a death benefit for your family, and they accumulated a cash value over time that functioned as a form of forced savings. Insurance salesmen were everywhere, and for many families, their life insurance policy was the closest thing they had to an investment portfolio. Fifth, and this is where things get interesting, you might actually buy individual stocks. After the war, there was a concerted effort by the New York Stock Exchange, brokerage firms, and the mutual fund industry to bring more Americans into the stock market. The NYSE launched campaigns with slogans like, "Own your share of American business." Firms like Merrill Lynch pioneered a new approach to retail brokerage, running full-page newspaper advertisements with titles like, "What Everybody Ought to Know About This Stock and Bond Business." They opened offices in cities across the country, trained salesmen to speak in plain English, and offered free research reports and educational seminars, even sponsoring investment seminars specifically for women. And it was working. A 1949 Federal Reserve Board survey found that 69% of Americans viewed the stock market negatively, a hangover from the Depression. But by the mid-1950s, attitudes were shifting. The number of individual shareholders rose to 8.6 million by the end of 1956, a 33% increase over just 4 years. The median income of new shareholders was actually falling, meaning the market was reaching further down the economic ladder. Younger investors were entering in larger numbers. The stock market, long the exclusive domain of the wealthy, was slowly opening its doors to the middle class. But even in this era of expanding access, there was a problem that nobody talked about openly. The game was rigged, not in the conspiratorial sense, but in a structural sense that was every bit as damaging. For most of Wall Street's history, the New York Stock Exchange required its member brokers to charge customers a minimum commission rate, typically a percentage of the par value of the shares traded. This was not a market-based fee. It was a cartel arrangement that guaranteed every member broker a share of the commission pie, shielding them from competition. For the average investor, buying a small number of shares, these commissions were punishing. The average commission was around 4%, but on very small investments, it could climb as high as 6%, not counting additional fees and surcharges that brokers tacked on. If you invested $100 and paid 6% in commissions, you had already lost $6 before the market even opened the next morning. And then there were mutual funds. By the early 1960s, 95% of mutual funds charged front-end sales loads averaging about 8.5%. That meant if you put $1,000 into a mutual fund, $85 went straight to the salesman who sold you the fund. You started out nearly 9% in the hole. As one SEC staffer noted in 1957, the real problems in the industry were largely centered on the selling methods of open-end securities. By the 1960s, a common saying on Wall Street was that mutual fund shares are sold, not bought. The industry was built on aggressive salesmanship, not on serving the interests of the investor. And this was the world that ordinary Americans had to navigate. No index funds, no low-cost options, no fiduciary standard requiring your broker to act in your best interest. If you wanted professional management, you paid enormous fees. If you wanted to buy individual stocks, you paid enormous commissions. And in either case, you were at the mercy of professionals who had every incentive to churn your account, recommend high-fee products, and treat your money as a source of their income rather than yours. In the background, a quiet revolution was brewing in academic economics. In the 1950s and 1960s, a series of landmark studies began to demolish the idea that professional stock pickers could consistently beat the market. Harry Markowitz's Modern Portfolio Theory, published in 1952, demonstrated the mathematical basis for diversification. Eugene Fama's efficient market hypothesis, developed in the early 1960s, argued that stock prices already reflected all available information, making it nearly impossible for any individual manager to consistently outperform the market. And then came the damning empirical evidence. Study after study showed that the vast majority of actively managed mutual funds underperformed simple market benchmarks after fees. The money you paid in commissions and management fees was not buying you superior returns. It was buying you inferior ones. The expensive professionals were, on average, doing worse than a strategy of simply buying and holding every stock in the market. This insight, so obvious in hindsight, was radical at the time. It struck at the very heart of Wall Street's business model. If professional stock picking did not add value, then the entire industry of active fund management was, in essence, a wealth transfer from ordinary investors to the financial professionals who served them. A few pioneering thinkers began to ask an obvious question: if you cannot beat the market, why not just buy it? In 1960, a young student at Princeton University named John Bogle wrote a senior thesis arguing that most mutual funds did not outperform broad market indices. It was a prescient insight, but it would take more than a decade before anyone had the courage and the institutional platform to act on it. The first practical step came in 1971, when William Faus and John McQuown at Wells Fargo established what is considered the first index fund. But it was designed exclusively for institutional investors, specifically for pension funds with millions of dollars to invest. Ordinary people could not access it. The fund tracked an equal-weighted index of all stocks on the New York Stock Exchange, and its creators later described the execution as a nightmare. Slightly later that same year, a firm called Battery March Financial Management in Boston independently pursued the idea of index investing. Its founders presented the concept at a Harvard Business School seminar, but they found no takers. For their efforts, they received the Dubious Achievement Award from Pensions and Investments magazine. The idea was considered so absurd that it was literally a punchline. In the early 1970s, a few more institutional index funds trickled into existence. AT&T ran extensive reviews of its pension fund managers and found that only 20% of them had outperformed the S&P 500. That revelation prompted them to shift $120 million into index strategies. Ford and Exxon began creating internal index funds for their own pension plans. The concept was gaining traction among the institutional elite, but the average American remained locked out. In November of 1975, one unnamed securities analyst working for a Boston bank was quoted saying, "I hope the damn things fail, because if they don't, it's going to mean the jobs of a lot of good analysts and portfolio men." And the following summer, the Nobel Prize-winning economist Paul Samuelson wrote an article in Newsweek explicitly lamenting the fact that retail investors had no access to index funds. He challenged anyone to create one. That someone was John Bogle. Bogle's path to this moment was itself a story of reinvention born from professional catastrophe. He had spent his career at Wellington Management Company, rising through the ranks until he was essentially running the firm. But a series of bad decisions, including a disastrous merger with an aggressive growth fund manager, led to his firing in January of 1974. It was humiliating, but Bogle appealed to the boards of Wellington's mutual funds and convinced them to let him create a new company that would handle the administrative functions of the funds. The board agreed, and on May 1st, 1975, Vanguard was born with a team of just 28 people. From the beginning, Bogle designed Vanguard around a radical structural principle. The company would be owned by its own mutual funds, which meant it was effectively owned by the fund shareholders themselves. There were no outside owners extracting profits. The company would operate at cost. Every dollar saved on fees would stay in the pockets of the people who invested. And then came the index fund. Bogle took the academic evidence, the work of Samuelson and Fama, and all the studies showing that active managers could not consistently beat the market, and he turned it into a product that ordinary Americans could buy. On August 31st, 1976, Vanguard launched the first index investment trust, the world's first index mutual fund available to individual investors. It tracked the S&P 500, and Wall Street hated it. The fund was mocked relentlessly. They called it un-American. They called it a guarantee of mediocrity. They said it was an acceptance of defeat, a surrender to average returns. One competitor distributed posters showing Uncle Sam with a clenched fist and the slogan, "Index funds are un-American." The financial industry had spent decades building a business model predicated on the idea that paying for professional stock picking was worth the cost. Bogle was saying publicly and repeatedly that it was not. The industry called his creation Bogle's folly. And at first, it looked like they might be right. Bogle had hoped to raise $150 million in the fund's initial public offering. He raised just $11.3 million. The fund did not even have enough money to buy all 500 stocks in the index. It could only afford 280 of them. By the end of 1976, the first index investment trust had accumulated just $14 million in assets, ranking it 152nd in size among 211 equity funds. Bogle himself described it as an artistic, if not commercial, success. It took nearly a decade before a second index fund entered the market. Competitors saw no reason to launch one. The idea was too unpopular, too threatening to their business models, and the first one had barely survived its infancy. But Bogle kept going. Slowly, year by year, the evidence kept piling up. Active managers kept underperforming. Fees kept eating into returns. And the index fund, charging a fraction of what active funds charged, kept doing exactly what it promised. It matched the market. It did not try to beat it. It did not try to time it. It simply owned a piece of everything and let the long-term growth of the American economy do the work. By 1982, the fund had crossed the $100 million mark, although only because it merged with another fund worth $58 million. By 1988, it hit $1 billion. And then something remarkable happened. The idea that Wall Street had called un-American slowly, relentlessly, inevitably, began to win. Now stop and think about what all of this means for the people who came before. Think about the factory worker in 1955 who wanted to save for retirement. He had no index fund. He had no low-cost option. If he wanted to invest in the stock market, he had to walk into a brokerage office, sit across from a salesman who earned a commission on every transaction, and trust that person to act in his best interest. He paid 4 to 6% just to get his money into a stock, and another 4 to 6% to get it out. If he bought a mutual fund, he paid 8.5% upfront plus annual management fees that were far higher than anything Vanguard would eventually charge. Think about the school teacher in 1963 who inherited a few $1,000s from a relative and wanted to do something smart with it. She could put it in a savings account earning 3%. She could buy savings bonds earning a bit more. She could buy a whole life insurance policy. Or she could walk into the intimidating world of Wall Street and hope for the best. There was no passive option. There was no way to simply buy the market and hold it forever. Every path was gated by fees, middlemen, and complexity. Think about the small business owner in 1970 who had finally built up some real savings and wanted to invest for the future. The entire financial system was designed to profit from his participation, not to serve it. The brokers earned commissions whether his investments went up or down. The fund managers charged their fees whether they beat the market or not. And the academic evidence, which was by then overwhelming, showed that most of them did not. This is the world that existed before 1976, a world in which ordinary Americans were essentially forced to overpay for underperformance or to avoid the financial markets entirely and hope that their pension, their home, and their savings account would be enough. The creation of the index fund did not fix everything. It did not eliminate fraud or incompetence or the inherent volatility of financial markets, but it did something that had never been done before in the entire history of American finance. It gave ordinary people a fair deal, a way to participate in the growth of the economy without paying a toll to gatekeepers, a way to build wealth slowly, steadily, and without needing to outsmart Wall Street. When you look at the numbers today, the scale of this transformation is staggering. Index mutual funds and exchange-traded funds now comprise well over half of all stock fund assets in the United States. Vanguard, the company that was born from one man's firing and launched with a product that raised barely $11 million, now manages trillions of dollars for tens of millions of investors worldwide. Indexing has become so deeply embedded in the retirement system that 96% of defined contribution retirement plans now offer target date funds built on index fund strategies. And that $10,000 investment in the Vanguard 500 index fund back in 1976, by 2025, it would have grown to over $2.1 million. $2.1 million from doing nothing more complicated than owning a piece of everything and leaving it alone. But here is the part that should make you uncomfortable. Here is the part that should keep you up at night if you think carefully about what it means. For nearly 2 centuries, the most powerful wealth-building tool in history did not exist. And during those 2 centuries, the financial industry was free to charge whatever it wanted, sell whatever it wanted, and operate with minimal accountability to the people whose money it was managing. The trillions of dollars that flowed from ordinary Americans into the pockets of brokers, fund managers, and financial intermediaries over those decades represent one of the largest, most sustained, most socially accepted transfers of wealth from the many to the few in American history. And it was all perfectly legal. It was all done in plain sight. It was all wrapped in the language of expertise and professionalism and the sacred American belief that markets know best. The index fund did not just change investing. It exposed the lie at the heart of the financial industry's value proposition. It proved that the emperor had no clothes, that the vast, expensive, credentialed apparatus of active money management was, for most people, most of the time, worse than doing nothing at all. John Bogle died in January of 2019 at the age of 89. By that point, the company he founded was managing nearly $5 trillion in assets. He never became a billionaire himself. He could have, easily, if he had structured Vanguard as a conventional company rather than as a mutual organization owned by its shareholders. By some estimates, his personal decision to forgo that wealth cost him billions of dollars in personal fortune. But that was the whole point. He built a company designed to serve investors, not to extract from them. And that distinction between serving and extracting is perhaps the most important lesson in this entire story, because every financial system in history has faced the same fundamental question. Does it exist to help the people who use it, or does it exist to enrich the people who run it? For most of American history, the answer was the latter. The index fund was one small, stubborn, revolutionary attempt to change that answer. And against all odds, against the mockery and the resistance and the entrenched power of the financial establishment, it worked. The next time you open your phone and buy a share of an index fund in 30 seconds for 0 commission, remember that you are doing something that was literally impossible for every previous generation of Americans. Remember the farmers who lost everything in bank panics. Remember the factory workers who were charged 6% just to buy a stock. Remember the school teachers who put their money into high-fee mutual funds because there was no alternative. Remember the millions of people who built Liberty bonds and war bonds and savings accounts and whole life insurance policies into makeshift financial plans because the system gave them nothing better. And remember that none of this happened by accident. Every barrier that was removed, every fee that was lowered, every regulation that was passed happened because somebody fought for it, often against the fierce opposition of the people who profited from the status quo. The history of investing in America is not just a history of markets and returns. It is a history of power, access, and the slow, painful, incomplete expansion of financial opportunity from the few to the many. That story is not over. It is still being written right now in the debates over financial regulation, retirement policy, and who benefits from the architecture of modern markets. And if history teaches us anything, it is that the people who control the financial system will always resist changes that reduce their share of the pie. The index fund won its war. But the larger battle, the battle over who the financial system is really for, continues. If you found this story valuable, consider subscribing to the channel and leaving a like. It helps more people find these deep dives, and it helps us keep making them. I will see you in the next one.